Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kurt Chisholm. I'll be your host, and today I'm joined with Ben Reinberg. Hey, Ben.
How are you, Kirk? Thank you for having me on. I appreciate it.
Great. Well, glad to have you on. Those of you who don't know Ben's into hard assets, commercial real estate. What got you into hard assets, Ben?
Well, when I was a kid and I was younger, Kirk, I was trying to understand how do I build wealth? I didn't come from money. And I realized from doing my research, there was no internet at the time. And so I would go to the library or I'd read the Chicago Tribune in Chicago, sometimes where I'm from, and realize that in order to produce wealth was to do through hard assets. And my favorite hard asset is commercial real estate. And so I learned commercial real estate. I went into the business as a principal, not as a broker. I went deep in the water and I did my first deal when I was in my early 20s.
That's ballsy. I mean, commercial real estate. Most people don't start there. What drew you there compared to residential, industrial? I mean, there's so many different types, but what drew you into the commercial part as opposed to residential?
Well, I wanted to do things differently. And I knew about commercial being from Chicago, office and industrial are big asset classes. There's also multifamily. I didn't want to go the multifamily route when I first started my career. So I went office and industrial. I learned, I perfected my craft. And tell everyone out there is that become an expert in whatever you do in life. And so for me, I said, I'm going to start with office and industrial. My first deal was a 95,000 square foot industrial building. I went to my godfather who sat on a board of a bank. And I said, Bruno, I need a loan to get this deal done. And he gave me an 80 LTV loan. I had nothing to lose. I signed with recourse. I had no assets under management or a balance sheet. So for me, I was blessed to get a loan. And I went out, Kurt, and I raised 2 million in 30 days. Yes, 30 days I did that. Took a lot of grit, a lot of heart, a lot of understanding. I'm also a CPA, so I understood numbers at the time. And I packaged a great deal. I went out and raised equity and closed on the deal. And what was interesting about the deal was I lost a tenant that had 50% of the income in the building after the first week they moved out. And I bought the building from two icons in Chicago that were huge, owned huge home building companies and were big in commercial real estate. But the lesson was important because I renegotiated it, I repackaged the deal, I subdivided it, and I brought in more tenants to add value. And then I sold it for a 3x multiple for our investors. But Kurt, the lesson wasn't in the 3x return. It was in what I bring here today. And it's understanding how to deal with investments. And the number one way for everyone to deal with investments, whether you're investing in a company, investing in real estate, is this one principle. It's called the ability to hold. The ability to hold, to ride through any cycle, recession, interest rate environment is the ability to hold. And when you can hold assets, you can produce wealth and create a lot of great experiences for you and your family.
Yeah, I mean, I totally agree. Buy and hold is a great strategy. The problem is you got to be pretty stable to hold through bad times because bad times inevitably happen if you're going to hold long enough. We probably have some ahead of us in the near future. So, how do you protect yourself during times like that? Like, how do you look at real estate in hard times to make sure you can hold? Because COVID was an
Right.
example of a tough time to hold for a lot of people. So, like,
Yeah.
what do you do to prepare yourself for that?
Well, let me just clarify. I'm talking about the ability to hold. Okay, you might not hold it for a long period of time, but if you have to, you do. And so let me clarify this because this is really important. I do not over leverage properties. I am a big proponent of debt. I'm not one of these guys who say debt's bad and don't use debt. Use smart debt. And so what I learned as a young age, okay, and I talk about this is don't over leverage your property or even the companies you buy. So for me, to give you an example, I don't do anything above 65% loan to value on an acquisition or on a refinance. Why? Because what happens is take 2 years ago, what happened? We're in a rising interest rate market. Values are dropping on assets, right? If you have a loan coming due and you have to refinance, you don't have enough equity to be able to salvage that property with your lender, and your lender's going to come calling, and you're not going to be able to refinance it. But if you go into an acquisition, okay, whatever your hard asset is, okay, and you have enough equity, you can deal with the what if. So that's ability of how you can hold. That's one example. The other is reserves. The other is underwriting real estate fundamentals properly if real estate is your hard asset of choice. That's what I'm an expert in. And so for me, I've learned being 55 years old and being in the business 32 years is that if you can create the ability to hold reserves, flexibility in your lending, don't over leverage any asset that you finance. These are all the things that will help you weather a storm because when you can have the ability to hold, what will happen is you will ride a cycle and you'll be able to sell that asset at the peak and be able to hold it. And you know what? Your investors will understand. A lot of people have fear and they say, well, what are my investors going to think if I tell them it's a 5 year hold and I hold it for 7 or 8? Well, guess what? Your number one job as a fiduciary of capital is to protect your investors' capital. They come first. And if that's the mantra, the hold another year or two is not a big deal. Because at the end of the day, people understand and realize that, hey, we went through a time that was unpredictable. It was rising interest rate, it was inflation, it was taxes, it was whatever might be the case that's pushing an investment to have a longer trajectory of your investment cycle. It's okay. But make sure when you go in and you're acquiring an asset, have the ability to hold, have flexibility in your lender, have relationships with your lender, don't over leverage, and make sure you have cash flow and build reserves. And I could assure you, no matter what, you will help to protect your downside, and upside will follow.
Yeah, I know you do a lot with medical properties too. Why medical properties? Like, what is the draw
Well,
there compared to any other type of commercial industrial?
well, Kurt, the human body is never going out of style, and it's recession and pandemic resilient type real estate. So 25 years ago, I thought I was going to be buying skyscrapers. One of my mentors was Sam Zaw, Chicago, big office owner throughout the world. And I said, well, this is where I want to be. And I realized with the internet and growing and how robust it was and the workforce, we realized that maybe owning large office campuses and towers wasn't the best thing to do. And we did at first, and we realized it's not the longevity of the business we need. And so we sat with our investors and I said, okay, we're going to come up with a different strategy. If we're going to invest in office, we're going to invest in medical office. People thought it was crazy with what was going on in the healthcare business at the time we started this. And we started with a little niche called dialysis. And we realized that kidney disease was rampant through the United States. And so it started growing. We started doing really well with dialysis. But we also realized that if you want a cash flowing asset with upside that's safe and secure and conservative, that's what medical office is. And we thought it was a great diversification. And 2.5 decades later, we're one of the leaders in thriving it. And so, what our investors love about it is that they realize that there's a high 80s percentile renewal rate on leases in medical. And so, there's so many benefits. And it's conservative, it's got great tax benefits, produces cash flow. And it's just a beautiful investment to have. And we've done really well in it. And it's one of the leaders in our portfolio now. And so, for anyone out there that understands that if you want diversification, medical office is a nice asset class because it balances a lot. And it's not a cowboy deal. It's not these high crazy returns. Even though we have a mid 20s IRR track record for medical, that's really unheard of. But the reality is that it's a safe, secure asset that produces cash flow and great tax benefits. That's why we acquire it.
So, what do you, I want to ask this. I mean, the commercial real estate market is um, a dumpster fire, to put it bluntly. I'm not sure if we're at the end, but I'm curious in your thoughts on where we are in the cycle with that, if we've got further to go, or if it's going to recover in the same way because people just aren't going to the office in the same way. So I'm just curious your thoughts.
Well, commercial real estate always lags behind the stock market. We have trillions of dollars of commercial real estate debt coming due over the next 24 months. Everyone knows it. And the banks have been preparing for it for 2 years. We've seen with the lack of liquidity, the lack of deal flow, investment sales were down from year 22 to 23, 80% in our industry. That's unheard of. We've never seen that. And so what's interesting is it's going to be great buying opportunities in the next 2 years that we've never seen before. You got a lot of debt coming due. Banks are going to be struggling to refinance. and interest rates are going to have to drop them. And so you're going to have this push pull effect of lenders are going to want to get capital out of the street to get returns, but also you're going to have debt coming due as well. So it's going to be interesting times, and there's going to be incredible buying opportunities in the next few years. And so it's a good tool for investors to come and invest with people like Alliance, my company, or to do it on their own. But you want to be very careful in this market. You want to really underwrite the real estate fundamentals. You want to look at market rent and vacancy rates. You want to look at your tenants and the credit worthiness of them. That's why people invest with us, because it's sophisticated. So be smart with your capital. If you're going to invest in commercial real estate, understand the playing field you want to be in. But there's going to be great opportunities to buy in this marketplace.
Yeah, yeah. So I'm curious, how have I know some businesses tariffs have been impacting business and some they haven't. How have tariffs been impacting your business or real estate in general? It doesn't even have to be yours, but just real estate
Well,
in general.
well, real estate in general affects the tenants depending on their business and depending on the asset class. It could be industrial. It will affect if they're importing different products around the world, especially from China. Uh, Cost of goods, materials for building buildings or doing tenant improvements have changed drastically, Kurt. So it's been a real challenge in our business because it affects our tenants. It affects the spaces that they're in.
How do you how do you square that? I mean, real estate is a pretty contained set of income and expenses with, relatively low variability. And then you throw that, whammy in there. Like, how do you just pass that along, or like how do you handle that?
Well, I mean, it's baked into the cost of goods if you're doing construction. If it's impacting your tenants, the reason how it impacts us is really operating costs and what they can afford in rent and how it's impacting their bottom line of their business. So it can impact you about, okay, well, you know what? With it, we might have to consider lowering rents, and in concession, we'll do a longer term lease to bring back the value. So it depends. It's really tenant centric, depending what kind of tenants you have in your buildings. It depends. But as it pertains to medical tenants, it's more about their supplies and how does it impact the hospital system or the actual physician group in that asset class. Industrial is different. We have different industrial, and it really depends on where they bring in their products from. Is it American made or are they importing as well? And so we look at all these factors, and we build relationship and talk to our tenants, and we constantly learn. And if we're doing tenant improvements or building a building, it's going to happen. It's going to affect rent, just like interest rates will affect rent as well.
Yeah, so you don't do any sort of share of revenue or profits like a
like
anchor store, right? Yeah.
like retail. Yeah, I mean the days of percentage rent are pretty much minimal in our business anymore. We do own retail, and not a lot of tenants do percentage rent. Not a lot of tenants do revenue sharing. Basically, it's more of an impact of what is the market rent in that specific sub market that's going to impact where those tenants are going to have to be and pay rent. So, when you have tariffs and you have inflation, you have these different items that are pulling at these tenants. It is going to impact land. It is going to impact lenders. It's going to impact landlords of values of properties. Properties are going to drop, so it does impact the value in a ancillary way, so to speak.
Yeah, I mean, you mentioned inflation too, which is another question. How do you handle inflation when the CPI is arguably a lot lower than what everybody else experiences for the inflation rate? I mean, I know for food we were getting
Mm-hmm.
since COVID it was 100% rise, and yet the CPI showed 23%.
Well,
So, you know,
what if I told you the safest place you put your money isn't safe at all? And
gold.
well, the very thing we've been told for years is to save cash, and that's quietly, relentlessly losing value every single day. And I want your audience to know that, because for too long, Kirk, we've been taught a lie about money. Okay. And we've been taught for years to work hard, to earn, to save, and to hope. And I'm here to tell you that that is a losing strategy. And savings accounts, we all feel like they're seemingly secure, but they're actually bleeding value, and they're eaten away by the opportunity costs, like inflation, like taxes, and by the relentless march of time. and time's our biggest asset. And so I want to let everyone know the reason why I invest in hard assets is to deal with inflation, to deal with taxes, to deal with keeping hoarding cash in a savings account that's not keeping up. Because what happens is if you're not producing returns, see, we knew the government wasn't being honest with us years ago. Inflation was in the teens on a national basis. Well, if you're not earning at least like 10 or 12 or in the teens percent, you're losing money without having your money working. And so people would ask me this question, Kurt, and they would say, well, what do I do with my money? I said, get it working in somehow because at least you can offset the negative balance of inflation to the return, that delta. And that's where the power of hard assets come in. And that's why what I'm doing and I'm out there explaining and teaching is so valuable in this market. Because especially right now, for everyone listening, is that get your money working. Don't leave it in a savings account. Okay. You can be conservative, but you want to get it working because there is inflation. You're going to have taxes and you need some sort of return on it to be at least balance the loss you're going to incur.
Yeah, that's not what I meant. I meant the inflation when it comes to real estate, right? You
Mm-hmm.
have costs, you have expenses, those go up. There's typically some sort of a CPI rider typically in rent. I don't know if you guys do that, but in most rents, there's some version of that. But it's not an accurate reflection of what this, what inflation truly is. So my question to you is if you have a rider in there of CPI, let's say, and that's
Mm-hmm.
3%, but the real rate's 10, how are you handling that? I mean, real estate for hundreds of years has been a great inflation hedge, but I feel like now we're in an era where the government always lies to you, but they're getting worse at it. So it just feels like, how are you able to handle that?
Well, the good news about inflation is it puts an upward pressure on rents. So generally speaking, you're going to have a higher rent because of inflation. And as inflation settles or interest rates do, your rents are still going to be up there, which is how you can add value as well. Generally speaking, CPI indexes we see a lot in retail, in our retail properties, but generally speaking, we see in medical you'll have 3 to 5% annual escalations. Industrial, you might have 2 to 4%, depending on the marketplace. Annual escalations have increased drastically this environment. And tenants are accepting it. They know it's normal, that it could be above what they're used to. And so when you are renewing leases, you have to look at these factors. And so how we're dealing it is we are looking at these annual escalations. We're looking at where market rent is. If there's an upward pressure on market rent and we're in a renewal, we're going to look at that and explain to the tenant. We're going to look at where is the vacancy rate in the market? Where's the upward pressure? We're going to look at absorption and we'll make a decision how to deal with it. But again, it goes back to what I talked about is the ability to hold. And the ability to hold is so important in this business because you're going to go, everyone thinks real estate cash flow is just a cent, right? But they're really like moguls. And if you can ride them, okay, through the inflation, through compression of rents, increases of rents, decreases in values, loans coming due. This is where the story is that all comes together with these factors that we're talking about.
Nice. Well, as we kind of wrap it up here, I wanted to get your kind of final thoughts as to what you think things are going to look like in 26, 27, 28, both from real estate and obviously capital markets as well, because that's changing quite rapidly right now.
Well, I think 26 is going to be exciting. I think we're going to have another couple drops in interest rates. It's going to provide a little bit more liquidity in the market. I feel that new businesses will come on. There's going to be some opportunities for new companies to be established. As it pertains to commercial real estate, there's going to be great buying opportunities. I think more people will be selling, there'll be more transactions, and I think it will help the marketplace by having more transactions going on. And so I'm very excited about the next few years. I think they're some of the best buying opportunities we've seen in years. It could be in the almost 3.5 decades I've been in commercial real estate. And so I'm excited about the future. As it pertains to 2027, I think we'll be back. I think the economy will start roaring again. I feel that all these wars will be settled, the chaos will be settled, and the geopolitical risk will subside itself. And I feel that inflation will be tamed. And so I believe that at the end of the day, in the next couple of years, we will get some stability in the market, which will give consumer confidence as well as lending confidence to start opening up for new businesses to come out, new loans to be happening, more transactions, and a more robust economy to happen. And I feel that the stock market will reflect it too over the next couple of years. So I believe there is hope. I believe the last 3 years have been a challenge, especially in commercial real estate with the lack of liquidity, lack of transactions, and lack of tenants running around. But I feel that will turn shortly. 5 years ago, we started this thing called personal brand. Every founder and CEO, we realized, needs a personal brand. So we built it. I now have my own TV show, the Ben Reinberg Show, and I own it, and the Real Estate Minute. And so that'll be streaming at a channel near you coming soon. We have 2 seasons already loaded. And so for me, the personal brand has been a huge impact to create impact, to help people teach about commercial real estate awareness, how to build wealth, how to buy hard assets too. And it leads into my book, Hard Assets and Hard Money for Hard Times. I wanted to give back to people and let them know that you can produce wealth. So people out there listening, if you're looking for a path to build wealth, that's why you take the book. And the book was so relevant to me because I didn't write it for myself. It wasn't a memoir. It wasn't about my stories. There's war stories in there. It's about an evergreen book to teach you how you can build a hard asset empire. And as a gift to your audience, if you go on my website, you can download the hard asset blueprint for free. And the reason why I did that is I wanted people to go back and say, well, what would Ben Reinberg want 32 years ago? And what would a billionaire want today? So the book was written for everyone in the blueprint. And so for everyone out there looking to learn and grow and say, okay, well, why do I need to build a hard asset empire? And I'll explain it to you. I realized at a young age, being from Chicago, where I'm from, is that every wealthy family around the world has hard assets in their portfolio. And it's been proven over time. And so when I wrote the book and created the blueprint, it's been forged in the fires of real world experience between myself and colleagues. And I wanted to share it with your audience to be able to understand that this hidden mystery about building wealth is now being revealed. And I felt it was my story. I wanted to reveal it. And I wanted to teach everyone out there that you're listening is that you can build wealth and you can do it through hard assets.
Awesome. Well, thanks for coming on.
Thank you, Kirk. I appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Ben. Appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hey, how you doing?
Doing great. Happy New Year. We also have our very own Doug Hagren. Hey, Doug.
Hey, Kirk, agree with you a little bit. Happy New Year, but that depends on your choices in 2026. So, it can go either way. Now's the time to make those smart choices.
Yeah, Doug's already hedging. It's the seventh day of the year. He's already hedging.
That's right.
Well, if you
Well,
like this, but if you like, you're a two-handed economist, Doug. On the
uh,
one hand, on the other hand.
hey, listen, nobody listens to a one-handed economist. They just can't stop staring at the missing arm. So,
Well, as they say, you can pick the price, you can pick the time, don't pick both.
there you go.
All right. Well, let's get started, Barb. So, what were some of your thoughts in the interview?
So much. I mean, real estate is my background. I grew up on real estate. I love real estate. I've been invested in real estate. And I got to say, our guest had some really good advice. One of the things that I particularly liked, and people don't say this enough, is don't over leverage. Because when the when the crap hits the fan, you can be in really big trouble if your debt is called. But there is so much to real estate investing, and I like the idea of having some real estate in whatever portfolio you own. And there are so many different ways to do that, whether you have, $1,000 or $1 million.
Yeah, agreed. Doug, what about you? What are some of your thoughts?
I'm just gonna start generally with a reality check. Most people out there, and this isn't just necessarily tied directly to real estate, but it's especially for anyone with real estate. I think most people think the biggest risk right now is what the market might do next, and it's not. The real risk is that too many investors still operating with yesterday's assumptions. There's cheap money, easy exits, and the idea that diversification alone equals safety. And the reality is that era is over. What we're dealing with now is a market that punishes drift, exposes weak structure, rewards clarity. Capital is more selective. Liquidity matters again. Terms matter again. Whether you're talking about commercial real estate, private capital, personal wealth, the winners going forward won't be the boldest, they'll be the most intentional. And so I think, today's conversation isn't more, it really isn't around hyper predictions, about how disciplined operators and investors are really understanding the need to reposition for a very different environment and what's going to happen to those who don't. We've shifted from the market that rewarded speed to one that rewards selectivity, from buy everything to buy only what survives stress. And I think that shift is going to separate real operators from those financial tourists out there. So, let's people got to get away from hype or nostalgia for the last cycle. They need to be able to be very intentional about being willing to reposition real assets, real capital, real expectations in an environment that is going to change, rapidly. Again, especially with real estate. I mean, floating rate debt, aggressive leverage, optimistic rent assumptions. Those are going to continue to collide in a market that demands more discipline, and liquidity is going to matter again. Cash flow is going to matter again, and structure is going to matter more than cap rate.
Yeah, I think those are great points. I mean, definitely cash flow always matters, or it should if you're a smart real estate investor. Unfortunately, most people invest for appreciation, which is the bonus. If you're not investing for cash flow, you're doing it wrong, in my opinion. A lot of people invest for appreciation. They buy things for zero cash flow, and they're like, oh, it'll just appreciate, or they buy it with a negative cash flow and say, oh, it'll appreciate, it'll get better. If you're not buying it for cash flow, move on.
Oh,
I think too many people just try to jump in the water and say, "Hey, it's safe," and they don't even look. And I think that's been one of the major problems with real estate right now. I look at real estate right now like that friend of yours that you have that borrows money and never pays you back. That's real estate today. It is commercial real estate is effectively an investment that could probably pay off 10 years down the line, but it's right now it's is digesting this huge shift we have in our economy, which is it used to be a staple, but now people just aren't working, and you got these corporations that can't get people back to work, and they got these empty office spaces, and they're downsizing because what the hell? Why do we need all this space if everybody can work from home? And granted, there are some companies that should work, from the office, but why do you have to? Like, I know the financial companies want everybody to get in the office. Why? I mean, you don't have to. I mean, everybody sits in front of a computer all day anyway. What's the point? So I'm not saying that everything is going to go there, permanently. There are definitely reasons to have people at work, but I think that shift in commercial real estate is going to take a while to digest, and it's still digesting, and I think it's going to be a while. But if you're buying for the appreciation that never comes, like the friend that never pays you back, I think you're just going to get hurt in the next in the near future. I just think that trends are everything's getting squeezed, and I think we'll probably see a lot more inventory getting on the market soon. So, Barb, I mean, you're a real estate expert. You've been in real estate for a long time. You've been successful at it. How are you looking at the real estate market right now? Like, where are you seeing opportunities, like risks? Like, how are you looking at it?
Great question, because the real estate market today is so segmented, like you alluded to, Kirk. First of all, office buildings, like you said, are they're really in a transition period because not as many people are going in. So what's happening in the office building market is a lot of them are being converted into housing because we have a lack of housing in this country, and too many office buildings. That's a great use for those office buildings, but it's going to take a lot of time. In fact, if you're a very long-term investor, um, maybe you want to look at that. But in terms of sectors, it's so easy to think about what's growing right now in our economy. And of course, data systems are insane because all of these new AI and computer applications, they need a place to house their uh, all of their infrastructure, data warehouses. Also, think of Amazon, FedEx. We also need these big storage centers. So those are really good areas. And in case you haven't noticed, the population is getting older. And the younger people are a smaller percent. The older people are like taking over. So what does that mean? Our guest talked about medical real estate, great idea. Senior citizen real estate, great idea. So if you are not going to get invested yourself buying and selling, I recommend or I suggest taking a look at something called sector REITs, which are real estate and publicly traded real estate trusts, and they invest in particular sectors. So I don't think it's a bad idea to look at some of these sectors that seem so clearly poised for growth, not for trading, but for looking at and aligning with long-term trends within the economy.
Yeah, I think it's good perspective. What about you? What are your thoughts, Doug? Any thoughts on, real estate and areas that have potential or even areas that have risk?
I'm going to say this right now, and I'm going to say this very boldly to anyone listening. If you're investing in real estate, if you've ever invested in real estate for appreciation, you're making an absolutely dangerous, foolish play with your money. Now, that doesn't mean you can't get appreciation. Okay? The average inflation or appreciation on real estate, and this is supposed to really, this is mostly residential real estate, going back to the Civil War, has been right around inflation. Now, if you're living there, it's an expense. It's a place you're paying for a place to lay your head and sleep. Now, if you're talking about investment real estate, and again, if you're talking about single family homes, I'm not saying you can't make money on the appreciation. There's a lot of people who are probably screaming at this as they listen to it saying, you know what, you're a fool. I've made my wealth through real estate. And I agree. Once again, going back to what I stated in the opening, there's been lots of easy money and it has allowed people to buy a lot of things cheap and has about things allowed people to buy them up under long-term inflation. It has also allowed them to buy them at a rate in which they could capitalize on that leverage, that arbitrage in other areas. But the reason I'm saying this is real estate's illiquid, flat out. And it's very expensive to acquire. It's very expensive to get rid of. So if you're going into it for appreciation, then you are going at it the wrong way. It is not meant to be something that you buy and then sell off. It's meant to be something that you do hold on to, and that a big portion of your return is the income that you generate off of it over the long run that goes into that appreciation. So if you can get several percent a year on your money through that investment and the rents that you get after all of the expenses, and then you can eventually, if you decide to liquidate it for an appreciation, wonderful. That's incredible. That's a bonus on top of it down the road. It's also something that the longer you hold it, the less that fixed cost of distribution is going to, is going to be on an per annum basis. So it is not something anybody should ever acquire for a quick flip. And I've seen it. I've seen a lot of people think that they're going to strike magic. I need to make quick money. I'm going to buy this. I'm going to flip it. And timing has been fortunate for many of them. It's been unfortunate for many of them. Um, I also, I think that the commercial real estate thing you were talking about, again, there's going to be people who are going to make a ton of money on appreciation over the long run, potentially. When you start to see these buildings that sold 10 years ago for close to $1 billion in value. I mean, some of these, especially in some of these urban areas, that are now selling for tens of millions. Huge losses being taken by whoever acquired them 10 years ago. Well, if you can get into them now for tens of millions, you don't need to have near the capital investment. You don't need to have near the vacancy to make something of it. That's, again, it's this is old Warren Buffett, right? You buy when others are running, okay? So I think there's opportunity to make there, but it isn't going to be instant. It's going to take time. I do think there's going to be continued demand. We're already seeing it to pull people back in the offices. I think that is it necessary? No, I don't know if it is in many cases. Now, obviously, you need people there for manufacturing, things like that, where they need to pull levers. But obviously, we're in a world for most things you can work remotely. The problem that we're running into with companies is control. As more and more news comes out there about people who are trying to balance work and life, and by working remote, you hear the stories of people working multiple jobs at the same time, collecting multiple paychecks. Is it the majority? I don't know, but it's certainly out there, and CEOs hear that. You hear about the people that are taking off time, logging in, and then going and taking their kids and running different places and take. Again, as long as those stories exist, you're going to have corporations are going to want people in the office for one reason and one reason only: control. And that is going to be, I don't know where that's going to head. I think the companies are going to continue to demand people come back to fight those challenges, but I don't know where the breaking point is. The other part that I think is going to be a risk, and we're seeing it right now, like Florida. Florida, real estate, commercial real estate, people have moved out the suburbs. Getting all these people back in commercial areas is going to be tough. But you're also talking, you mentioned the boomers. We have a huge population of boomers that have some of the most expensive real estate in the country. They're the biggest holders of it. They're waiting to sell that onto the next generation. The reality is the next generation, A, can't necessarily afford it. B, the next generation doesn't necessarily want it. So that's going to be a huge breaking point, and they're sitting on it, but they're sitting on it to the point in which they may not be able to outlive that wait. Okay, so they're patient. They don't have to worry about it in most cases until a medical situation requires downsizing. But what's really going to happen with a lot of them is eventually they're going to that real estate's going to outlive their life. Now what happens to it? And we are going to start to see an increasing appreciation of not increasing appreciation, increasing acceleration of homes that will become available because the owner occupant is no longer available. Okay, and that is going to certainly create some challenges in that area that I think to me, I think we're going to see a glut of real estate that is going to develop over the next decade. And that's not just commercial, that's residential. And again, we got to shift with this because when I see the mindset of people, it's still very much stuck in what worked 5, 10 years ago, just like just by the S&P 500 worked 5, 10 years ago. And I think if you're not being flexible and fluid to these changes, it's going to bite you.
Yeah, no, it's interesting. I remember Barb probably remembers this. I remember back in the day there were all these real estate gurus. I had to pull them up because I couldn't remember them all. You had Carlton Sheets was like the goat of real estate gurus. You had Albert Lowry. You had Lonnie Scruggs, Ron LeGrand, Robert Allen. Um, yeah, I mean, those are some of the ones I remember. There were some more here on the list that I had to Google this because some of them I couldn't remember. But there's so many of these old school people that used real estate as a way to make lots of money. And what the interesting draw was back then was there was no access to information. You basically learned about this at 2 in the morning at a at a 2 in the morning infomercial, where the guy was sorry, my dogs are going nuts over here. At a 2 in the morning infomercial where you're sitting there. I don't know why you're up at 2 in the morning, but I was a kid, so I was up because hell, why not? And watching these things are like, wow, look at all this free money. I could be a bazillionaire with no money down, and you have no effing idea what the hell you're doing. And I remember at like 15 or whatever, I was like, I want to do this. So I bought these things and I learned, and it was great. And it was great education because there was no internet to figure this out, right? There it just didn't exist. So you couldn't all of a sudden figure out like, hey, I'm going to do A, B, C, and D, and I'm going to go research this. It's like if it wasn't an infomercial, you didn't know about it. Like, what's a tax lien? Nobody knew what tax liens were unless you were working at a bank and you knew these things, right? You just didn't know, or you worked at the government, the municipal office where they had these things. You just didn't know unless you bought an infomercial, like, course. So all these people who had books and courses, they were a great way to disseminate information about great ideas. The problem with the internet is everyone has this information. There are no secrets anymore. There are no real estate secrets. Like, ooh, a real estate it doesn't exist. The last real estate secret I found was basically using VRBO and trying to rent by the day, basically becoming a hotel. And you're somehow able to make, returns on that are reasonable for real estate. Well, the problem with that is that's the only way you can make money in that real estate, because if you were just to rent it for a year, you'd lose money. So the only way you can make money is rent it by the day. And you know what? That's a job. Not only is that a job, but that's a real business that takes a lot of time and effort. And is it worth it? I'm not saying it's bad, although most of the people I talk to who have the VRBO rentals are not making money. They're waiting for appreciation. They're basically more or less breaking even, give or take a little bit. Maybe they're making a little money, but the risk is that people just stop renting it, and now you've got this big anchor, this financial anchor. So back in the day, when you had who was it? Albert Lowry? Who was the one? Oh, it was Robert Allen, the no money down, the nothing down, multiple streams of incomes. He was famous for like, I can go anywhere and I can put no money down and buy real estate. Well, that's great, but if you don't have any money, you're kind of screwed, right? How are you going to make it all work after that? No money down, but it does cost money. It is a business. So I always found those things fascinating and really interesting, and they helped a lot of people make a lot of money. But anyone tells you, hey, look at all the money I've made. Okay, what are you going to do tomorrow? The real estate market is different than it was in the last 20 years. If you made money from 2010 until today, you're not a genius. You're just lucky because of the time frame that's involved. If you had to buy real estate today, I wouldn't be buying real estate today. But I did, but I live here. I'm not renting it. And even then, I've told people on the show, I know I top tick the market. I know the market's going lower from here. It's not going higher. But I'm okay with that because it's
Time to
a place
flip
I'm
it,
living.
Kirk.
Yeah, I know. I'm gonna flip it. I'm just I'm gonna put a sign out front and said, "Hey, I discovered gold. Anyone want to buy my property?" What was it? Mark Twain's definition of a gold mine is a hole with a liar on top. Like it's so anyway, my point is I think a lot of people like selling the idea of real estate. They like selling courses on real estate. They like to sell their gurus on how they're awesome at real estate. And there are a lot of smart people out there. I'm not knocking any of them because they are teaching people about real estate, which is a valuable skill. I just bought a home and I'm still learning. Like you buy stuff, you discover stuff. You're like, holy crap, I had no idea. Like I'm learning about the heating system. It's a crazy mess. I mean, it works, but it's like I don't understand this. People walk in, they're like, I wouldn't have done that. It's like so. My point is you're always learning stuff, even after you buy, and even if you think you thought you knew everything. Um, so you can make money in real estate, but you got to be really careful, and you have to be really discerning about what you buy. And I think that's always the key. There's hundreds of millions of properties out there. You don't have to buy them all. Just wait and find the one that makes sense for you. Get really good, get really smart before you start putting money up. I know it's nice, cool, and sexy to put very little or no money down, but at the end of the day, that's your credit on the line. So if you screw up, your credit gets screwed. So you got to be really careful. Um, I personally, I like Barb's idea of sector ETFs, but you have to really understand real estate to begin with. You have to understand the trends. Nice part about real estate is if you buy it right, you can make money. If you don't buy it right, it's gonna be a long time before you make money, if you do it all. So you got to be careful. Real estate ETFs are a great way to get involved without taking a whole lot of risk, especially if you don't understand real estate. If you're just getting involved, find low risk ways to do it, like partner up with somebody, and you do the work, and they put up the money and the credit, and you do the work. So you learn and you help them, and you make money, but you don't have financial risk at the time. Or I think Doug mentioned about flipping. Flipping's not easy, but there are zero risk ways to do it. And I'll share one, and I'll hand it off to Barb. I think it was 20, no, it was 20 some odd years ago. I was it? No, I'm sorry. It was 2000. It was in, yeah, sorry. I think it was around 2008, 2009, somewhere around then. Anyway, the market crashed, and everyone was just kind of just despondent in general. Well, I looked at the government websites. I said, "Hey, what properties is the government trying to get rid of?" Because you can find these sheriff sales, government sales, foreclosures, all these things. The government basically liquidates their assets and puts them at auction. So I'm looking through the websites. I'm like, oh, this is interesting. So I bought a course, by the way. I bought a course on how to do this. So I didn't know how to do it. So I learned, and I started going through, and I started looking through these properties, and I was like, oh, this is really interesting. Um, and there were tons of garbage. I didn't know where they were, but I found one locally. Right, a lot of this stuff is in Texas. Like I don't know Texas. I don't know if there's good or bad property. Anyway, I found one locally, and I was like, oh, this is interesting. It was in a residential neighborhood. It was it was a really weird property. So it was actually enclosed, so you didn't have access from the street, but there was an easement to get access. So it was basically two houses, and behind the two houses was this big lot, and there was some water, some wetlands on the property. But I was looking at this, I'm like, oh, this is kind of interesting. And I think I put $1,000 down, or five. No, I put down $500. Okay. Um, and I bought this property for, I think it was probably valued at, I forget off the top of my head, but the property was valued, I think, somewhere around like 200,000. And I was going to buy it for 50. No one had any interest. I was going to buy it for 50. It was like no access. There's a lot of problems. There's like power lines. Anyway, so I'm looking at this. I'm like, all right, even nothing else. I'll see what I can make of this. Right? I had $500 at stake. What's the worst that can happen? And I think I could have got that. I think I got the $500 back. I gave myself time to inspect the property. I gave myself like, I think it was like 4 weeks to inspect the property. So I inspected the property. I'm like, all right, this is good enough. And so I was looking at it, I was like, all right, what can I do with this? I was like, well, where's the opportunity? Because I was like, I can't sell it. I'm going to list it. It's going to take months. I'm not going to, I'm not going to put up 50K because if I'm wrong, I'm screwed. I was like, I have $500 that I'm getting that back anyway if I decide I don't want it. So what I did, I went up there, I talked to the neighbors, and I said, here's what I'm doing. And I looked, and there was no cell signal, by the way, which I realized I was pissed, and I was like, you know what? I could put a cell tower there. So I started calling cell tower companies to see if they were interested because there's no signal there. I talked to the neighbors, and I told them what I was going to do. I'm going to put a big cell tower right here. Do you want to buy this from me? And I figured I would flip it for 50,000 up to like 80, 100, but and we landed somewhere around 80, and I was like, all right, it'd be about 80,000. And so I talked to the neighbors, and I was going back and forth and basically telling them I'm going to put like this obnoxious cell tower in your backyard, and or also there's an easement through the property. I'm just I'm paving a road right through your yard, like all these things I was saying because I was trying to see like what can I do to monetize this setup, and I ended up not going forward with it because I didn't have enough time to make it work. But that's an example of where you could flip it. I was just looking for an opportunity to flip it. I had $500 max at stake, which, like I said, I was getting that back. I could have gotten an extra month, but I decided, you know what, I'm not making any headway. I'm not doing this. But basically, it cost me nothing to do, and most $500. And if I could have gotten some headway, I would have done it. But nobody was biting at the time. But that's an example of how you'd flip it with no risk. And I thought that was interesting. It was a lot of fun. Do I want to do that for a living? Hell no. That was a huge pain in the butt. But that's a way you can do that, right? Is you find ways to lower the risk as much as possible. The last thing I was going to do is buy this property and then try to flip it. That would have been really stupid because I don't know what it's worth. It's a property that you can't access from the street, and it's a lot of wetlands, and it's really an ugly piece of property, and all these other things. So anyway, I just wanted to bring that up because I think, there are ways to still do it, but you have to be discerning. I looked through hundreds and hundreds and hundreds of properties and found only one on the government website that was of interest. And I'm sure there were other good ones, but I didn't understand them. I didn't know where they were and wasn't willing to travel to Texas to check them all out. So what about you, Barb? I mean, you've done these sort of things in the past. Is it worth it for people to still do this, or are these opportunities just gone now?
First off, I thought that was a great example, Kirk. A really creative example. Now, back in the day, before the internet, I used to live in Cincinnati, Ohio. And what our company would do, and I was actually in real estate before I transferred into finance and investing. I would go to a local sheriff's sale, no internet then. And there'd be a gang of us all standing around bidding on properties that were for sale from the municipality. Now, these properties I had the address on, I could not go inside. So I was actually making a determination of how much I was willing to buy those properties for without seeing the inside. So I had to do some really smart analysis and say, okay, I'm going to assume XYZ is what I'm going to pay for repairs. I could be right, I could be wrong. But like Kirk, I bid on many, many properties before one of my bids was accepted because I didn't want you overbid, you're not going to make any money. And then from there, I'd get the property, I'd own it. I would, with a team, I would renovate it, update it, either sell it or rent it out. And it was a viable income stream. Now, some people can still do that. Obviously, the process is different because of the internet. It's much different, and it's also probably a little more competitive than it was in the day. But that's kind of a full-time business, or for someone who's a total workaholic, the idea of buying undervalued, more properties that are in need of repairs, you have to be really smart in estimating what you're going to have to put in. What are the selling costs, the upgrading costs, and then what is your profit potential? But that is a viable way to get into real estate, get your hands dirty, and start out making a career of it. Or if you have a lot of energy, you can do that in addition to a full-time job. Kirk, you mentioned Texas. The key is you probably will have better likelihood in areas which are not as in high demand or as expensive. Because here in San Jose, I mean, a crap building, a crap house, you're lucky if you can get it for $800,000. So you need a lot of capital in the first place. But if you go to Detroit, Texas, different parts of the country, or if you live in one of those parts of the country, you can get a house for 50,000 or 100,000. You put some money in, you flip it for 200. That's legitimate profit. So again, we are covering the different ways that real estate works, different ways you can make money in real estate. With the exception of REITs, which are public securities, trusts listed on the stock exchange, which you can buy and sell in moments. These other types of real estate offers, you have to have a lot of patience. You have to be willing to hold them for a while in many cases and require a heck of a lot more work. I would like to turn it over to Doug and say, talk about syndicates or buying in with some of those, because I think that's another way that people who really want to get into real estate can potentially get into the markets.
Yeah, and a footnote before Doug, don't buy in Detroit. Just saying. Uh, go ahead, Doug. You got some thoughts on this?
Hold on. Why not Detroit? Because I've seen Detroit as a really growing market. I
Um,
mean,
oh, I guess it
you could.
depends. So, all right. So let me just. I was doing that somewhat tongue in cheek. I mean, you used to be able to buy a few years ago for like $100 a property in Detroit, but um, so I just want to give this framework before Doug talks. There's and I don't have this framework I'm just kind of shooting from the hip here. But one of the things that's important, as you said, Barb, is the area has to be growing. There has to be economic prospects in the area. If you're buying in a town that you've got a bunch of strung out people on the street and a bunch of homeless, it's probably not a good area. If the mill closed and there's no job prospects, you probably don't want to buy real estate there. You want to buy in areas that are growing. They don't have to be high end. You can buy them in lower economic areas, but there has to be some growth potential. That's the thing about Texas is there's sprawl. It keeps expanding. So if you're in the area where it's expanding, you could do quite well and buy things cheap. So Texas is not a bad area. But you look at areas like California and New York where the net population is negative. It's negative growth. Like you want to be careful in areas like that. So Detroit may be growing. I haven't looked recently, but it's not on my radar of places that I would look because it's just I just don't see where the opportunities are coming from. I could be wrong though. Do your own research. Uh, Go ahead, Doug.
You want to go back to something you said a little while ago, when you were talking about the old days of infomercials at 2 a.m. and the internet these days. The other thing to think about and remember with the internet these days is that it is kind of a well-known tongue-in-cheek that the only people that make money are the ones that sell the books, right? Well, the ones that are making money on the internet a lot of times are it's not because of what they did. It's selling you the concept of what they did. Actually, someone just posted about how they were getting on a plane and they're trying to get to their seats, but it was held up because this lady just jumped into coach and they're taking a picture. They didn't like it. So they took another picture. They didn't like it. Took another picture. So they're taking all these pictures, not in coach. I'm sorry, in first class, in business class. And eventually they were happy with their picture, but then they got up and walked back to coach where they were really sitting. Okay. That's the internet for you. It's a lot of fakery, a lot of selling you on concepts that may or may not be tested, sound really good. There's tons of stories about people with their, sitting there showing you all the money they made on a private plane that they rented just to take the photos. So just be very careful. I guess I'll take the run there, Barb, since you threw it over to me on syndicates. And honest, it's not an area that I'm, an actual, very, big expert on, but I'll talk about that a little bit more. I mean, what is a real estate, syndicate? It is it's a sponsor, a general partner will find the deal, they'll raise the capital. We've had a couple of people, I think, Kirk, that you've interviewed, they've talked about this, done this. They operate the asset. I think that was a person out of Florida that's all they do is well, they're doing that with businesses. They do more of that's right. There was somebody you interviewed that did more of that with businesses. They find the partners to buy the business, and then he just sits back and they run it. They take a lot of that risk. But you have the sponsor that finds it, then you have the investors with a limited partner, so they're not the general partner. They provide the capital, they get the cash flow upside, but they have no day-to-day control. So the syndicate, you're not really buying real estate, you're buying a business run by someone else, and there's a lot of distinction there that matters more than ever. Now, when it can make sense right now, it can be smart if certain conditions are met. Number one, you want exposure, you don't want a second job. Real estate's a lot of work, okay? And if you're not gonna want the time that it takes and to run that, then you're gonna generally pay a property manager, which have very mixed reviews. Most people say they do not get their money's worth from most property managers. But they're gonna take a huge cut. So a syndicate might be one of those where you kind of get that middle ground. You don't want to manage tenants or contractors. You do want professional operations. You want access to larger institutional size grade deals. The syndicates can be one of the cleanest entry points there. The other thing too, the deal cash flows today in this market. If it doesn't cash flow on day one, you got to walk. Deals relying on refi magic or rent growth in the next 24 to 36 months are high risk. So you want to target conservative pro formas, you want a realistic expense assumptions, and you want debt service coverage that's going to survive stress. So the sponsor, has real cycle experience. You're going to want someone who operated a 2008 to 2009 or 2020, not just someone who's only operated in, these easy money periods. You want managed workouts, not just growth, and someone that actually talks openly about mistakes and downside cases. Anyone who just says, hey, this market is different is not who you want holding your money. Some red flags you should not ignore. Overpromised IRRs. Still see these coming out. 18 to 25% target IRRs are often marketing math. You need to ask, what's the return without the appreciation? Going back to what I said before, the two are intertwined. And if the deal needs everything to go right, it's not a deal. Another red flag is heavy reliance on floating rate debt. Many 2021 to 2022 syndicates are still underwater because of this. Rate caps do not fix a bad structure. They're just going to delay your pain. You also don't want to ignore thin reserves. If you're going to go into real estate directly, again, liquidity matters. Don't sink all your money into this asset thinking you can get out of it. You need to have sufficient reserves on the side to weather that longevity, to make sure your exit timing is right. Same thing here. Reserves are minimal. The LPs become the emergency fund. So you need to ask how many months of operating expenses are in your reserves. And you also need to be very careful of complex fee stacking. I've seen this firsthand. A lot of times they'll bury in acquisition fees, asset management fees, construction management fees, refinance fees, disposition fees. This is like private equity. They just strip the expenses out. Fees are not bad in anything. We have this, we kind of go two ways in this world. We're either blind to fees and we get absolutely taken by them. But now we also have, because of that, this rhetoric out there, especially on FinTwit, you should never pay anything. Do it yourself, it's free. Totally disagree. Fees are not bad. It's just hidden or misaligned fees are. So, the sponsor needs to be on the property. You cannot fix a mediocre property. It's got to be a very good one. You cannot also fix a bad sponsor. You want to find out how much of their own money's in the deal, right? If they're not investing in it and you're taking all the risk, that's ridiculous. They need to be putting that risk in themselves. How do they get paid if the returns underperform? How often do they communicate? What do they share when things go wrong? When deals go sideways, what do they do? If there's vague answers, move on. Realistic framing, you should be thinking about maybe, 7 to 9% current cash flow is strong. 10 to 14% total return with conservative assumptions could be respectable. Upside is gravy, but it cannot be the plan. Anything higher should come with clear, explicit risk disclosures. You need to understand syndicates are generally going to be illiquid. They're going to be long-term, 5 to 10 years, and they're going to be dependent on exit markets. So never invest your emergency funds, never invest your tuition money, never invest short-term capital, never invest money tied to retirement income needs in the next 5 years. Syndicates belong in a concept that I've talked about in the field, the stuff you do not have to go and get right now. If there's locust or drought and it doesn't grow that year, you're going to be fine. Do not put a syndicate or real estate in general in your silo or your delivery truck. I will tell you where they shine. Tax angle, right? Lots of opportunities have done right to depreciation shielding, K1 losses, potential loss cost segregation benefits, which are huge but expensive. Passive income offset for qualifying investors. But again, none of these tax benefits fix bad deals. You must coordinate with a broader tax plan. Do not chase depreciation alone. So, summarizing, smart way to enter a syndicate: start with a small allocation, diversify across sponsors and property types. You need to favor boring, needs-based assets. There needs to be demand transparency, stress test the downside, assume capital calls are possible, treat the upside as optional, not guaranteed. Syndicates can be a smart way to access real estate. They're professionally managed, they're tax efficient, but they can be very opaque, over-levered, and sponsor-dependent disasters. So the difference in structure, it's discipline. Make sure that you follow that. And I would say the same thing about things that are not syndicate. Real estate in general, all of what I just said, same concept.
Yeah, no, appreciate that, Doug. Barb, we want to wrap it up here. Final thoughts from you.
First of all, Doug, great job for someone that professed to not know much. I think you cover the gamut. So don't sell yourself short.
You're a
I
tremendous
am
slouch, Doug.
Exactly. Don't.
I'm I'm Barbara Friedberg. You can find me and a ton of content on real estate at Barbara Friedberg Personal Finance, and you can find me on YouTube.
Great. Thanks for coming on, Barb. And Doug, final thoughts from you.
All right. So this is exactly where we at Mergent Advisors come in. We don't look at real estate or syndicates in isolation. Matter of fact, we partner with those that understand it best. Where we focus, we help families and investors understand where opportunities like this fit inside the broader plan. And that plan includes retirement income, college funding, an area we know better than most people out there, and is an area where there's tremendous tax and saving opportunities that most people, especially high income affluent families, do not take advantage of, and they lose money by paying college after tax. Sure, you might have the cash flow for it, but guess what? You probably have higher lifestyle needs, and if you're smart with your money, you're going to want to figure out ways to use it more efficiently. Ultimately, tax strategies and estate planning. So before we ever talk about returns, we're going to make sure for you that your capital is positioned correctly, that your short-term needs aren't going to take long-term risk, that your tax benefits are intentional, and that liquid investments are sized appropriately. Real estate can be a powerful tool, but it's only going to be when it's aligned with the job that money is supposed to do. So our role isn't to sell you deals. It's to provide clarity, discipline, and structure. So when you do invest, it's part of a plan, not a reaction to the moment. Because markets shift, cycles turn, and smart money doesn't hope, it always plans. If you want more information, go to our website, www.mergentadvisors.net. That's MERGENT, 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 mergentadvisors.net. You can also get all of the information on our Mergent College planning strategy there as well. Douglas Hagren, look forward to speaking with you soon.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.